Hi, Russell. So, Eastwatini, or Swaziland as we used to call it, has had a lot of big changes in last year. So, very big changes for a very small country and a small economy. Can you talk us through, in general, what has happened in Eswatini and what are the key changes to be aware of for any business operating there?
Yeah, sure. Yeah. It is a small country. There were a lot of changes in 2024, and we're not going to run through all of them, but some of those are part of what we're seeing across the continent, and some are perhaps more unique. But a lot of sort of modernisation of the Eswatini tax system. And so we'll concentrate on the corporate rules. A cut in corporate tax rate, always welcome.
And not one we see often across Africa?
Not so much. We're seeing a bit of it, perhaps particularly in the south, maybe in Nigeria if they follow through on their current attempts to reform the tax system. I think it's all part of a bit of a recognition that companies don't pay tax; they're a conduit. So ultimately, you've got to tax individuals. So cutting a corporate tax rate is useful, and it keeps the country more competitive with competing investment destinations. So cutting the corporate tax rate, a bit of a change to incentives, in that there's this incentive for development enterprises. You can get a 10% rate for 10 years. That doesn't fit entirely well with Pillar 2, does it? But yeah, it's an attempt to encourage investment into the country. And then, yeah, those were two of the perhaps appealing rules. Other things have been less appealing. So we can think of a number of them, such as loss carried forward limits. This is increasingly becoming a trend across the continent. So
Yeah, we saw that in South Africa a couple of years ago. It used to be you could trail forward your losses forever, but a lot of countries are now reducing this.
Well, South Africa took a more measured approach to it, perhaps, where they said you can carry loss forward, you just can't shield your entire profits within a year. If you're profitable, you must pay some tax. And I've got some sympathy with that. Eswatini's gone the cruder method, saying after 5 years your loss disappears.
Expire, yeah.
We have seen a couple of countries recently, as Zambia and Namibia, I think, come to mind, where they say we'll do both. You can restrict how much you can use, and you'll still forfeit it after a time period. So that's Eswatini could have been worse, but yeah, 5-year carry forward for that. Interest expense deduction limitations, which again is becoming very common. So so you can only deduct a portion of your EBITDA, earnings before income, depreciation, tax, and amortization, in order to get your tax deduction. In Eswatini, they've been a bit unrefined again. That restriction applies even to third-party interest.
Yeah, which is, I mean, that's quite unusual. I mean, generally there's a recognition that third-party interest is a normal commercial requirement, and it's just connected party interest that's restricted. So this seems quite punitive.
It is quite punitive. I think it's perhaps partly the benefit of being simplistic, relatively simple law, and saves the inspector having to work out who the lender was. And secondly, perhaps a bit of a feel that you don't want to encourage too much debt in your companies in your country, because it increases the risk of bankruptcy or failure. And so perhaps trying to save companies from themselves. That's being perhaps overly generous to the drafters of the law. But there you go. Capital gains tax. Capital gains tax, a bit mixed mind as to whether it's a good or a bad thing the way they've done it. It's because it's a bit of both. It's very common to have a capital gains tax across Africa. They've introduced it. The good thing is it's only on gains after 1st of July 2024.
So Russell, before this, there was no capital gains tax at all in Eswatini.
No,
unusual.
As in many countries, there's still quite a few who don't have it, and maybe it's up there. But yes, they've given into the normal trend across the continent to have a capital gains tax, but at least they're saying only from the introduction date.
Yeah.
Which probably means you need to work out what the value of your assets was on that date.
Yeah.
Also got quite an interesting little indexation thing for certain types of assets. So that's, again, it's a future problem, because we're not far after the 1st of July 2024 yet.
But as you say, the key is to do a timeous valuation, so you have your base cost.
That's right. Yes, and get used to the idea. And there are a few funny things we haven't listed here, where a careful reading of the treaty, especially if you're a South African investor in Eswatini, will be useful to protect yourself from some of the new withholding tax rates, but we didn't list them on their slides. TP rules, yes, again, increasing a trend. A lot of countries had anti-avoidance legislation, and a lot of tax authorities had started using those to address transfer pricing issues, but it was all a bit vague and nebulous, and nobody really knew where they were. So Eswatini is now created clear transfer pricing rules, which are pretty much what you'd expect. They're in line with OECD normal methodology and approach, but they're now all codified. So we can expect a bit more attention from Eswatini Revenue Service when they're looking at tax returns.
So overall, Russell, it seems like quite a large scale kind of modernization and rejigging of the entire tax regime in Eswatini. So definitely anyone who's operating in Eswatini needs to look carefully at how these changes could impact the business.
I'd say so. And there's one we haven't listed up on the slides yet, which is manufacturing income or income of manufacturers. Now ring fence. Now I still haven't worked out entirely what that means. Where's the boundary between manufacturing and other activity? Maybe that's all you're doing. But if I grow a tree and chop it down and turn it into planks,
What part is manufacturing and what part is something else? Yeah.
there was a Zambian case which I just saw a couple of days ago, which was a sugar farm which processed its own sugar and turned it into crystal sugar. And again, was it a manufacturer or was it an agricultural enterprise? And those sort of boundaries. Every time you get these problems, these boundaries get difficult, both from an accounting point of view. How do you create the numbers for the different activities, and for how the tax law works? Where is the tax boundary?
Wow, yeah. So some quite complex questions that can arise there, and definitely lots to consider for the small number of businesses who are operating in Eswatini.
Indeed, yeah. But yeah, although there's a small number of businesses, there are some quite significant businesses in any country.
So if you've got anything happening in Eswatini, erstwhile named Swaziland, contact us.